Welcome to the deep dive. Today we're really getting into the Paramount Skydance Q3 2025 earnings call.
Yeah, the first big outing for the new management post-merger, now trading as PSKY.
And the key thing here, this call wasn't really about Q3 results, was it? It was all future focused.
Absolutely. The market seemed to look right past the rearview mirror. So our mission today is to, break down those numbers quickly, but really dig into the strategy they laid out.
And figure out why the stock actually popped despite some pretty rough headlines.
Exactly. So let's hit those headlines first, because if you just read the wire, it looks bad.
Right. Significant misses.
Yeah, GAAP EPS, the standard accounting number, came in at negative 12 cents.
Which missed the estimate of what, positive 34 cents?
By a mile, like 46 cents off. And revenue wasn't great either, $6.7 billion versus expectations closer to $7 billion, $6.97 billion to be precise.
So misses top and bottom line. And yet, the stock went up, about 5% after hours.
Tells you everything, doesn't it? Investors were completely focused on the story, the forward guidance, the strategic narrative.
Okay, so the actual performance was mixed then. It wasn't all bad.
Definitely mixed. Direct-to-consumer, the streaming side, grew strong, up 24% year over year. That's good momentum.
But the traditional TV side?
TV media declined. Yeah, down 12%. That's the secular headwind right there.
Right.
But film actually rebounded nicely, up 30%, probably getting an early boost from Skydance joining the fold.
And Paramount Plus kept adding subscribers.
It did. Another 1.4 million net adds. They're pushing almost 79 million total subs now. So the scale is building.
Which leads directly into the strategy, because scale needs efficiency. And that seemed like priority number one, cost savings.
Oh, absolutely central. They didn't just reiterate the old target. They blew past it. They raised the run rate efficiency savings goal from $2 billion.
To at least $3 billion. $1 billion more. That's a huge jump.
It is, and it's not just, trimming the fat everywhere.
There were workforce reductions mentioned, about 1,600 roles.
Yes, that's part of it. But the really big lever they're pulling is technology, a major overhaul.
You mean consolidating the streaming platform?
Exactly. Getting Paramount Plus, Pluto TV, and BAT all onto one single tech platform. That's the big project, targeted for mid-2026.
Okay, why is that so important? It sounds like plumbing, but they're betting billions on it.
Because right now it's inefficient. 3 platforms mean 3 tech stacks, 3 engineering teams, lots of duplicated effort and cost. Unifying it saves money directly.
Okay, operational savings.
But it's more than that. It lowers customer acquisition costs, or CAC. And critically, it lets them build much better ad tech across the board.
Right, better targeting, higher ad rates.
Precisely. And think about Pluto TV, the free service. Right now, it's hard to seamlessly move someone enjoying Pluto over to a paid Paramount Plus subscription.
The systems don't talk well?
Not optimally. Unification makes that transition smooth. Pluto becomes this giant built-in funnel for the paid service. That lifts ARPU, average revenue per user.
Got it. So the tech isn't just saving money, it's designed to make money. And those savings are funding some pretty aggressive guidance for 2026.
Aggressive is putting it mildly. They're projecting total revenue around $30 billion for 2026.
$30 billion. And what about profit? They use that OEID metric?
Right. Adjusted OEID. Think of it like their version of adjusted operating income. They're targeting $3.5 billion. That implies huge margin expansion if they hit it.
But wait, they're also increasing spending? Didn't they say over $1.5 billion in incremental programming investment in 2026?
They did, yes.
So cut $3 billion here, spend $1.5 billion there. How does that math work out to profitability for DTC in 2026, which they explicitly guided to?
It's a calculated risk. They believe the $3 billion in cost savings from synergies in tech will hit the bottom line faster and more reliably. The $1.5 billion investment isn't random spending. It's targeted fuel for DTC growth mission of big movies, key series.
Premium stuff they think pays back quickly.
Exactly. They're betting that the efficiency gains plus focused content spend equals DTC profitability in 26. It requires sharp execution, obviously.
And part of that content spend is revitalizing the film studio side, right? Thanks to Skydance.
Yeah, big time. Paramount Pictures is set to basically double its output, going from maybe 8 movies a year to at least 15 starting next year.
And the focus is on quality being the best business plan, as they put it.
Right. They highlighted some big anchors, too. That exclusive South Park deal for streaming.
5 years, huge deal.
The James Mangold film with Timothée Chalamet. And adapting Call of Duty, that's a massive IP. These are the kinds of things meant to draw and keep subscribers.
Okay, let's shift gears a bit to another huge content piece they focused on, the UFC.
Oh, yeah. That U.S. rights deal starting in 2026 was clearly a major strategic pillar for them.
They sounded really pumped about it, called it a unicorn.
A unicorn sports property, yeah. Because unlike, say, the NFL or NBA, which have distinct seasons and off seasons.
The UFC is basically year-round, event after event.
Exactly. Constant appointment viewing, constant marketing buzz potential. It doesn't have that lull.
And the strategic fit with their audience seems pretty clever.
Very complementary. UFC brings in that younger, heavily male demographic, which pairs really well with the existing CBS audience, which, driven by procedurals and news, tends to skew a bit older and more female.
So CBS provides the mass reach, UFC brings in a valuable, different demo, makes the whole ad proposition stronger.
Absolutely. Broader appeal, more valuable inventory, and crucially, they're getting rid of the old paywall structure for UFC.
Making it easier to access.
Much easier. No more double paywall. That opens it up to potentially what they said was 100 million fans just in the U.S.
Yeah.
The idea is to convert many of those directly into Paramount Plus subs.
Makes sense. Now, what about the legacy stuff, the linear channels? There's always talk about spinning off cable.
They address that head on, acknowledge the difference. Broadcast, CBS, still very profitable, very important for reach, feeding into DTC.
But cable?
Cable's declining, yes. Nickelodeon, MTV, BT. But, and this was emphatic, they're not spinning off those cable assets.
Really? Why not?
They basically said history shows those kinds of spin-offs haven't really created lasting value elsewhere in the sector. So instead of selling them off low, they plan to transform those brands internally.
Use them to feed the core streaming business somehow.
That seems to be the plan. Leverage the IP and brand recognition within the Paramount Plus ecosystem, rather than just cutting them loose.
Okay, interesting strategy. And on the financial side, keeping those assets plus the merger debt, how do they get the balance sheet healthy?
The target is clear. Reach investment grade ratings across the board by 2027. That dictates a lot of discipline.
Which includes M&A, or lack thereof.
Very disciplined M&A, strictly a buy versus build analysis. And they were clear. They feel they can build everything they need internally.
So no big acquisitions likely unless it's a slam dunk.
Seems that way. Any M&A would have to very clearly speed up one of their main goals. They did confirm they're selling some non-core stuff, those over-the-year Spanish language assets in Latin America, tidying up.
Gotcha. One last financial point. Free cash flow. Investors always watch that. What's the story there?
Near term, it's going to look a bit messy on a reported basis.
Yeah.
Because they've got about $800 million in one-time costs hitting merger fees, tech integration expenses.
Cost of the transformation.
Right. But they stress that adjusted free cash flow, backing out those one-offs, will stay positive. And long-term, they expect improvements from better working capital management and better tax rates.
Okay, that covers the strategy, the numbers, the moving parts, a lot to digest. Which brings us to our This Is Not Financial Advice segment.
The fun part.
Based on everything they laid out, what's the outrageous but plausible trade idea here for PSKY?
Okay, so the thesis is this. The market right now. It's too focused on that near-term $800 million cost drag for the tech integration.
Understandable, it hits reported cash flow.
Right. But they might be seriously underestimating the upside synergy from that unified tech platform, especially when you throw the UFC into the mix from 2026 onwards.
So the market sees the cost, but maybe not the full potential benefit yet?
Exactly. So the trade idea, go long PSKY equity, but you need patience. This is a bet on the 2026 timeframe playing out.
Okay, long the stock. Looking out to 2026, what's the outrageous catalyst?
The outrageous but plausible part is that the unified platform works perfectly. It funnels those Pluto users to Paramount, plus seamlessly, the boosted ad tech lifts ARPU significantly.
And then the UFC hits.
And the UFC hits, providing unique year-round content, especially filling that summer gap where other sports are quiet. The combination pushes subscriber growth and ARPU way past what analysts are currently modeling.
Creating a big operating leverage surprise.
A dramatic surprise. You get the $3 billion in cost savings fully baked in, maybe even hitting early, while the $1.5 billion content spend led by UFC and the bigger film slate pays off almost immediately in terms of subs and engagement.
So it's a bet on flawless execution leading to results way above expectations in the back half of 2026.
That's the bet. High risk if they stumble on execution, obviously. But if they pull it off, the upside could be substantial. It's banking on tech and content clicking together perfectly sooner than expected.
A very ambitious scenario. Okay, that wraps our deep dive for today. Paramount Skydance, PSKY, clearly making a choice. Short-term pain, dealing with integration complexity and costs.
for what they hope is long-term strategic clarity and ultimately profitability.
And the message integration, huge savings, premium content focus with UFC, South Park, more films that definitely seem to land with investors, overriding those backward-looking misses.
It's a compelling story, no doubt. But integrating complex tech across legacy media assets is, well, it's notoriously difficult.
Absolutely. Which leads to the final thought for you, the listener. Management keeps emphasizing technology as a multiplier, enhancing performance. So the big question is, can this newly merged, still quite traditional media company actually transform itself into the most technologically advanced player in streaming?
Before its bigger, potentially more nimble global competitors lock in scale, that's just too hard to overcome.
That's the multi-billion-dollar question, something to chew on as you watch this strategy unfold.